Capacity looks forwards, productivity looks backwards. Your administrators will make or break your firm. Make sure you're hiring top people that are super motivated, they're well paid, and they do a great job. Every interaction you have impacts capacity, which is why workflow and capacity are one and the same. You can never grow your firm because you're constantly in the situation of putting out fire. My name is McTavish, and I'm the CEO and co-founder of Link. We provide practice management for high-performance accounting firms. My goal with these videos is to teach you the art of running a firm, which is centered around 5 core principles and how they all play together. Growing an accounting firm is a game of hiring to create capacity, then onboarding clients to fill this capacity, and then hiring again. You then repeat this process over and over. So my name is McTavish, and I'm the CEO and co-founder of Link, which provides practice management for high-performance accounting firms. Over the past 15 years, I've analysed the data for more than 1,000 firms all over the world, which allows me to see what separates the high-performance firms from the ones that get stuck. My goal with these videos is to teach you the art of running a firm using 5 core principles and how they all play together. In this video here, we're going to look at how high-performance firms plan their growth. So when we talk about planning growth, we're talking about planning. And planning in the context of accounting is capacity planning. We want to know what people we have and what work we're going to give those people and how much available capacity we have. So capacity is the total hours available for client work after accounting for leave and making allowances for internal time. Another way to think about it is it's the production plan for your team. It allows us to look at what we have coming up, and then we can then fill our capacity. If we run out of capacity, we can hire to build our team. So here we're going to look at a simple annual capacity plan. So I've got my team members here, and we're going to add some values into this to see what this firm's capacity is. Now, this is something that you could do at any stage in a spreadsheet or even on the back of a napkin, which allows you to see how much capacity you have and how much work you can take on before you do need to hire someone again. Right, so we've got the hours per week. We've got the hours per year each team member works. We've got their target capacity. You notice Vanessa and Frank are both administrators for us. We've got our billable rates, our target billable hours, our expected non-billable hours. Again, you'll notice Frank and Vanessa, all their time is expected to be non-billable. And then we have our target productivity. Capacity looks forwards, productivity looks backwards. So productivity is looking at the billable time you've done divided by total time done. So it's looking at that ratio between billable and non-billable time. Capacity is our projection of how much time we expect each team member to be working on billable activities. So if our plan falls into place perfectly, our capacity and our productivity will be identical. So when we're operating our firm at capacity, our productivity and our capacity will be the same. Finally, we have our target revenue. So based on the billable rates of each team member, their target billable hours, and assuming they are working at capacity, that is how much revenue each team member can bring in. So we're looking at 52.57% as our target productivity. It's actually under the 55% sort of golden target that we want to be aiming for at a firm level. So high performance firms have a deliberate structure with clear roles. So what we're going to do here is we're going to look at an example of how to grow a firm from a startup to a $5 million turnover. So I'm going to take you through the approach I would take in terms of who I'm hiring and at which stage I'm hiring them. So this is our growth plan, right? So it's the same numbers we just looked at, or sorry, the same metrics we just looked at, but we're going to look at giving some job titles to these people. So we've got 1 partner, we've got 1 administrator, we've got no managers, and we've got 1 accountant. So 3 staff, but our administrator in this situation is only working 20 hours per week. That's all we need them for, so we're paying for 100 hours per week. So we're going to start our plan here. This is like a very small startup firm, 1 team member and an administrator, and we're going to grow this firm to a $5 million turnover. So this is the hours per year each team member would be working. We've got our target capacity. So we want to be aiming our capacity at 80% or above. So let's just say it's 80%. Then what we can do is we can apply discounts on capacity for each administrative activity that we need to do. So this partner here has an accountant that they're looking after, so we can give them a 5% reduction in their capacity. So the accountant's at 80% and the partner, being a manager of the accountant, will be at 75%. We then have our billable rates. The partner's set at $250. And then our accountant at $200. We've got our target billable hours for each team member, and then our expected non-billable hours. And you can see that our administrator, 100% of their time will be non-billable, keeping in mind they are only 20 hours per week. So we have our target productivity, and the plan we're looking at here is assuming we are operating at capacity right now. So at capacity, once we've filled the partner and the accountants all their work, we'll be at 62% productivity. Target revenue 300 grand for our partner and 256k for our accountant, giving us 556,000 target revenue at a firm level. Now this is a nice little startup practice. This is a good little practice here. 62% productivity, just over $500,000 of revenue. So a great firm. So what we're going to do next is we look at our next hire, right? So we're going to hire another accountant. So now we've got 2 accountants, our administrator and our partner. So 4 team members in total. We've still got our administrator at 20 hours per week. And you'll notice that our target capacity for our partner, we've dropped from 75 down to 70% now. And that's because they're managing 2 people. So not only they're doing their own billable work, they're doing the reviews for their accountants or reviewing their work, which is billable activities. But they're also managing their workflow and they're managing their capacity and making sure that their team members are on track for all of their KPIs. So there is a level of management that goes into each accountant. We've got our billable rates, billable hours, productivity, and then we've got our target revenue here. And you can see that we're at 65.7% target productivity now, which is looking great. So this is a really high performing practice here. Just under 800k target revenue. Now, for our next hire, what are we going to do? We're going to hire another accountant and we're going to promote our first accountant to become manager, or we'd hire a manager. So it depends on what the structure or what people you have at this stage in your firm. But the next hire is going to be really key. We're going to bring on a manager or promote someone to manager. So we now have 5 team members. The other key thing we've done now is I've lifted our administrator up to full time, because now that we've got a manager in place, we've got a bit of structure going on. There's probably going to be a bit more admin floating around in the firm. We probably want to bring on an administrator to full time now. So whether it's a new person or we up that person from full time, depends on your situation. But now what we can see here is our partner's target capacity is now at 65%. So what we're doing, every hire, we're slowly dropping the partner's capacity back, because we want them focusing on sales and onboarding and growing the firm and a bit of management. So we really do want to look at reducing our partner's capacity the more the firm grows. But on the early days, they've got high capacity because we want them generating that revenue to create the cash flow to hire these people. But as we can start leaning on our team more to generate that cash flow, we can start reducing the target capacity for our partner here. Now our manager, they would be at 80% if they're a billable team member, but they also have 2 accountants they're looking after. So they're looking after their workflow and their capacity and making sure that they're tracking to their KPIs. So we give them a 5% reduction in their target capacity for each team member, bringing them to 70%, our accountants 80%. Now, because we've got a manager in place, we've actually lifted our partner's billable rate from $250 up to $300 an hour, because we have now that manager there to take on that high value work. We can now afford to put our partner's rate up to $300. So by bringing on a manager, we also lift our partner's rate there. So we've got our target billable hours, giving us our productivity. Again, this is as if the firm is operating at capacity. So there is going to be a time delay. Once we hire our manager, we're going to have capacity. So then we need to go and sell, bring on more clients, fill that capacity. But once we're operating at capacity, we'd be at 59% productivity. And we've just cracked $1 million in turnover with our 5 team members. So well done. All right, so our next hire, we're going to hire another accountant. So with that, we are going to have the partner's target capacity reduces by another 5%, and our manager would also reduce from 70 to 65, because now they're looking after 3 team members. And then we bring through to our target revenue. So we're actually, our productivity is up at 60.8% now. So we're looking really good here. This is a high performance firm, $1.3 million in turnover. So our next hire, it's going to be another accountant. So now our target capacity is 55% for the partner and 60% for the manager, because the manager would be at 80%, but there's 4 people they're looking after. Therefore, we give them a 20% reduction in their target capacity for the management they're doing. So 20% of their time would be on general administrative activities, training, team meetings, all those things. Another 20% of their time is looking after their team members' workflow and making sure the work's allocated out nicely. And the final 60% is there for their high value client work and also reviewing the work of their team members. So that's a manager operating sort of at capacity there. Got our billable rates, target hours, we've got our productivity all the way through to our target revenue. So 1.5 million, really, really high performance team here, 62% productivity. Now, our next hire, we're going to hire another accountant and promote another manager. So now what we've done is we've changed our ratio from 1 manager to 4 accountants, which is optimal. But to grow the team, we don't want to have 5 accountants to 1 manager. We're starting to really stretch that manager. Too many reviews. We start finding that we have a bottleneck in our firm around reviews and getting work checked off. So we want to make sure that we promote one of our accountants to managers. So now we've got a 1-to-2 ratio from our manager to accountants. And of course, what we're going to do now is our target capacity for our manager is going to increase again because we don't have 1-to-4, we've now got 1-to-2. So we can now lift our productivity for each manager in relation to how many accountants that they're looking after. Our partner, again, we're slowly bringing that target capacity down. So we bring this through, our target productivity. I forgot to mention earlier, we also looked at increasing our administrator up to, admin is where that's our next thing. We're going to get another administrator now. This administrator is probably feeling a lot of pressure right now. So 63.8% productivity, fantastic productivity. This firm's humming. Probably a lot of pressure on admin right now, so we probably want to fix that problem. $1.8 million turnover. So our next hire is going to be an administrator, just like this. So what that's going to do is it's not going to change anything apart from our expected non-billable hours is going to double from an admin perspective. So our firm level productivity has dropped all the way down to 56.7%. And this really highlights how much an administrator can drop firm level productivity. So we do need to be careful about how many administrators we are hiring in our firm. So we're down at 56.7. We want to keep that above 55%. So we're above that. So we're still a high performance firm here. And obviously our target revenue has not changed. So we'll do another hire here. This time we're going to hire another accountant. So that's obviously going to have 1 manager will have 3 people, 1 manager will have 2 people. And then what we're going to see here is our productivity starting to climb up now. We're up at 58%, so we're starting to head back up again. So as you can see, productivity is such an important metric to keep an eye on. We're at $2 million. We've cracked the $2 million mark now. So what we're going to do next is we're going to jump a little bit further ahead. So I want to look at what an optimal structure would look like under a partner. So we've got 1 partner, we've got 3 administrators, and I've got 4 managers who are looking after 4 accountants each. So we've got 20 billable team members here between the managers and the accountants, 3 administrators and the partner. So this is 24 people under this part of the firm. And this is your dream firm here, really. So we've got 38,400 hours. Our target capacity, we've now got the partner down at 30%, and that could sit at 50%, it could go to 40%, it could be at 20%, but we want to bring our partner down and they're just doing that really high value consulting work, that coaching work for those really high value clients, because they can start passing a lot of their work down to these managers. And then what we do at that point is we increase our partner's billable rate. So I've got it at $400 an hour now. So as the productivity bottoms out, we go, cool, we don't want to lift productivity anymore. The law of supply and demand, we're not going to increase supply. Demand will continue to increase the bigger the firm gets, so we're going to put our prices up at that point. So here we want to start looking at lifting our rates rather than putting our capacity up. Cool, and then if we look at our productivity, 64.6%, so basically 65% productivity. So this is a beautiful firm operating really well. We've got our target revenue here. We're doing over $5 million, and this is for a single partner. So the take-home profits for this partner, you'll be looking at sort of north of $1.5 to $2 million profit out of this firm. So this is sort of your dream structure of a firm. You may have an extra administrator here. There may be other people involved, but this is a typical sort of dream structure that I would suggest for a firm, and those are the steps you'd take to grow the firm. So the key insights from that is your billable team members should be 80% productive, and managers receive a 5% reduction in target productivity for each team member they manage, like we saw. Managers need to manage their people with their 5% time allocation, not just review jobs. So managers, they'll be reviewing the work for your team members, but we also want to give them that non-billable time for managing workflows. They want to be looking at their workflow, prioritizing jobs, looking at which clients are complaining because their work's late or whatever it is, which jobs are stuck, which are stagnant. They'll be calling clients to chase information up. That stuff, that's where that 5% allocation comes from. So they're not just doing reviews, they're also managing their team members. So you want to aim to have 4 accountants per manager, and from what I've seen, that's the optimal structure there. Partners can reduce their target capacity and lift their billable rates as their team grows. So as we saw, once we brought on a manager, we raised our rate from 250 to 300. And then once we dropped our capacity down to 30%, we put our rate up to 400. So as capacity reduces, rates increases for these partners. and hire the fewest number of administrators you can get away with. So you really want to be hiring top level administrators, really, really good people, rather than hiring a whole lot of part-timers who are not so engaged with the business. So your administrators will make or break your firm. So you want to make sure you're hiring top people that are super motivated, they're well paid, and they do a great job. For the capacity plan we just looked at, it's a really basic plan, right? So we're looking at the people that we have, we're looking at the target capacity, and we're looking at the number of hours they have available to take on the work. But that's a static plan, and it's actually not going to allow you to make those micro decisions to grow your firm about where we fill capacity, which team members are over allocated, who's stressed, who do we need to take work off, who needs help, all of these things. That static plan is not going to help you. So the static plan is great if no staff leave and you hire no new staff. It's great if everyone hits their exact productivity target every month. If no jobs take longer than expected, it's a great plan. No jobs are completed faster than expected. No new work comes in and no clients leave, and everyone takes exactly their full amount of entitled leave for the year. So I just put these in here to highlight that a static capacity plan is a great rule of thumb. It helps you understand what capacity your firm has. By no means is it a management tool to actually make those micro decisions day to day about your firm. So capacity is the natural byproduct of your workflow system. Your workflow system must measure and track capacity in real time. So let's look at what monthly capacity would look like for an individual team member. So we have the hours per week that our team member is contracted to work. They have the hours per day. They have the work days in the month, and that's going to change based on the date that we're looking at. The hours in the month. Less leave taken. So if we take leave, that reduces their availability, of course. So their available hours in this situation will be 160 hours. Now, if the target capacity is 75%, we then allocate work to our team to build our capacity plan. So we know what someone's target capacity was. So we know that they are going to have 160 hours available. We know that the 75% target capacity. We can then look at how much time they can spend on non-billable and how much time they can spend on billable activities. So our target capacity, 75%. Allocated internal time is 40 hours, so they have 40 hours up their sleeve of this month to do non-billable activities, which is 75%, which is 25% of their time. So we've got no work allocated to this person yet, so their available capacity is 120 hours. So if we add those values together, we get 160, which is the available hours in the month. Now, if we allocate some work to our team members, we're going to start seeing our availability drop, right? So if I allocate 10 hours to this team member, they now have 110 hours available. So 40 hours is set aside for non-billable, 10 hours is work that's been assigned, and I've got 110 that are just available to take on more work. So it's a very interesting value knowing that I've got 110 hours of work available to me, or hours available to me to take on work. Now, if I get 90 hours of work allocated to me, that's going to give me 30 hours remaining, right? So what keeps capacity live for our team members? So that's a great little plan. We know that we have 160 hours available. We know we have 40 of those hours allocated for non-billable, and I've got 90 hours of allocated to me for my billable work, give me 30 hours remaining. But how do we keep that live? So every new allocation impacts capacity. So if someone gives me a 5-hour allocation, I'd go from 30 down to 25 hours of available capacity, and I'd have now 90 to 95 hours of allocated work. So every new allocation impacts capacity. Every reallocation impacts capacity. So if I take a job off me and give it to somebody else, it's going to reduce my allocated, but increase my available capacity. So every completed task impacts capacity. So if I have a 10-hour task, and as I'm working on it, if I put 6 hours to it and complete it, well, I had 10 hours allocated to that task. And then when I finish it in 6, there's 4 hours I no longer need to do. So then that's going to create 4 hours of new capacity for me. So completing tasks also impacts capacity. So every timesheet impacts capacity as well. Every interaction you have impacts capacity, which is why workflow and capacity are one and the same. Capacity needs to be part of your workflow system. So there are 4 types of timesheets that can happen. So this is our starting point in the example we just looked at, right? So we've got 30 hours of available capacity. Now, if we add 8 hours to an internal task, what would we expect to happen here? If we add 8 hours to an allocated billable task, what would happen? If we add 8 hours to an unallocated billable task, and finally, if we add 8 hours to a leave task. So what would happen under these situations? So what would happen for our internal task is we would end up having 32 hours of remaining time for our internal time. So we had 40, we put 8 hours of time to internal, that gives us 32 remaining. Now, if we add 8 hours to a billable task. It's gone from 90 down to 82. We now have 82 hours allocated to us because we've spent 8 hours on one of those tasks. Available capacity doesn't change. Now, if it's a unallocated billable task, that's not going to affect our billable work. We've still got 90 hours of work to do. I just happened to work on this task I wasn't allocated to, so that's going to reduce my available capacity, isn't it? So it's going to go from 30 down to 22 because it hasn't come out of my bucket of time for internal, it hasn't come out of my bucket of time that I've been allocated, it has to come from somewhere, so it comes from our available capacity. And the last one is if we add 8 hours to leave. In that situation, it's going to split between my allocated internal, so I'm 75%, right? So 2 hours will come out of my internal time. My billable time hasn't changed, so it comes out of my available capacity. So now I've got 24 hours available capacity, which is the 6 hours of that 8 there. So in all these situations, 8 hours of timesheets, it reduces my total available hours from 160 to 152, and it's going to bite from one of these 3 buckets here being internal, billable, or available capacity. You are in the business of buying and selling capacity. That is what your firm does. You buy capacity. We don't buy an hour and then sell an hour. You buy someone for the year. You buy their time for the year, and that creates the capacity. That creates the 1,600 hours that you buy, and you go, cool, well, we're going to sell 80% of those hours, right? And then your job is to fill those. So you buy capacity, and then you sell capacity to your clients. That's the game you're in. So it's very, very important to track our capacity and make those micro decisions around who's been over allocated, where can we move work around? Because if someone's over allocated, you're going to find they're going to start getting behind on some of their deliverables, and that's how you upset clients. Your team members get stressed, your clients get upset, you have clients leave and you have team members leave, and then you can never grow your firm because you're constantly in the situation of putting out fire. Where if you have a really clear capacity plan of who's working on what, all the due dates are being met, and you have your managers managing your team, it's just going to be the smooth machine that you can fill capacity and then you hire again, and then you fill capacity and you hire again. But if you're not managing it, you're going to find that there's going to be fires all day, every day, people leaving, clients leaving. It's going to be a nightmare. So having a workflow system with capacity built in is so important. So let's look at a visual representation of capacity. So we've looked at the situations of available capacity and your billable and your internal. Let's look at a visual representation of that. So we've got silver, which is our allocated internal. We've got blue for our allocated billable. And finally, green will be our available capacity. So we got our partners, administrators, managers, and our accountants, like the structure that we set up before. So your partner, that's that 50-50 split we've got here between billable and internal. Our administrator, all internal. Our manager, and finally, our accountant. If we bring in some numbers, we can see 50%, 50%, and then our manager is 35-65, and our accountant is 20-80 split between their billable, their available, and then their allocated internal. Now, if we were to look at that in terms of their hours, assuming there's 160 hours in this month, these are the hours that we would see. So what we'll do here is we're just going to have another accountant. We're going to have this nice little firm of 5 team members, and we're going to swap out some names here so we can put some real people in here. So Trish is our partner, Rebecca's our administrator, David's our manager, and we've got Simon and Hannah as our accountants. All right, so let's look at some events. Let's look at things that would happen, right? So if we allocate 60 hours of billable work to Trish, we are going to replace some of her available capacity with allocated work. So we had 80 hours available capacity, now we've got 60 allocated and 20 hours available capacity to take on more billable work. So the next event is David, Simon, and Hannah are all allocated work for the month. Just like that. So now this is what our work would look like once it's all allocated out for the month. Now Trish adds 10 hours of time to an internal task. So that takes 10 hours out of our allocated internal. She's now got 70 hours remaining. So every time we timesheet, we reduce the amount of available hours in the month. Now Trish timesheets 20 hours to an allocated billable task. Just like that. So as you can see, the more we timesheet, the more this chart reduces. Now Trish timesheets 10 hours to an allocated billable task without any remaining budget. So she's put 10 hours to a task and the budget's all gone. So that means although it's allocated to us, the allocation right now is 0 hours, because if we had a task that had a 20-hour budget, she's put 22 hours to it, we only have 0 hours remaining on that task, right? Because we've gone over the budget. So When she puts time to that, it actually reduces her available capacity because there's no time remaining in that job that's sitting as a blue bar here. So in that situation, it reduces our available capacity. Now Trish timesheets 10 hours to a leave task. It's going to reduce both her allocated internal and her available capacity. The last one here is Trish timesheets 10 hours to an unallocated billable task. So that's not part of her blue, it's not part of her silver. It's billable work, so it is productive, but it's not on her list. That's going to reduce her capacity, right? It's 10 hours that wasn't in this plan. So what that will do is it'll make her over allocated because the amount of time she has available has gone down, but the amount of billable work she has hasn't changed. So now she's actually over allocated. And this is the thing that we want to keep an eye on with our live capacity, is seeing if people start having red in their charts that they become over allocated, and we know that this person's getting under pressure. They may miss deadlines, they're becoming stressed. So this is what your managers are doing. They're keeping an eye on these red charts to see if someone's becoming over allocated, and they can go and move some work around. Perhaps we could give some of that work to David as a manager. We might find a job that Trisha's been allocated that we can give to David. Perfect example. So growing a firm is a game of hiring to create capacity, then bringing on clients to fill that capacity. That is the game, right? So live insight into capacity allows you to balance workloads and grow your firm with confidence. So that's how high performance firms plan their growth. They have a very clear understanding of what roles they have and what roles they're hiring for. They make sure their productivity doesn't dip under 55%, and they have a really clear capacity plan. They know how much work each person's allocated, and they're constantly monitoring it. If someone becomes over allocated, they can move work around to ensure deadlines don't get missed, and also our team don't get overwhelmed by compounding deadlines. So if you found this video useful, I'd love to hear which part of it you found most insightful, so let me know in the comments. And if you are running a high performance firm, or you are wanting to one day, consider subscribing to this channel, and I look forward to talking to you in the next video.